Welcome everybody. Thanks for joining the webinar. My name is Chris Ashton. I'm the head mentor at the Corellian Academy. My background is in trading, where I worked at UBS and then Barclays for 20 years. Now, 4 months ago, I presented our first webinar on technical analysis techniques and strategies, where I covered how you can use support resistance, Bollinger Bands and Fibonacci retracements to support your day-to-day trading. This was popular with Plus500 clients who wanted to get the most out of their charts and indicators available on their Plus500 platform. Now, if you couldn't join us on that webinar or you haven't watched the recording but would like to, the link is on the Zoom chat for you right now. Moving on to today, I will introduce 3 new technical analysis techniques that I feel can be useful to you when trading in the current market environment that we're all facing right now. So with that in mind, let's look at what I'll be discussing in today's webinar. As I just said, I'm going to cover those 3 new technical analysis techniques, and these are understanding trends, using moving averages, and utilizing the MACD indicator. For each technique, I will highlight how and why it can benefit your trading, show you where to find them on your Plus500 charting system, and show you how they can be used. At the end of each section, I will then showcase one of 3 case study examples from earlier in November, which will be the NASDAQ 100 index around the US election, gold and dollar yen. For each of these examples, I will show you how you could have applied the technical analysis technique, that technique would have shown you about that instrument, and how it could have benefited your trading. And then at the end of each section, I'll provide you with some key takeaways, which are the basic points you need to know when utilizing these techniques in your trading. Now, at any stage throughout the webinar, if you do have any questions, please feel free to put them on the chat or the Q&A section of the Zoom webinar, and either Richard, who's here with me tonight, the Corellian Technical Analysis Mentor, or I will answer them at the end of the presentation. If it's a specific question related to the Plus500 platform, a member of their customer service team will come back to you later in the week. Okay, let's move on to understanding trends. So in the previous webinar, on technical analysis, I discussed support and resistance and touched briefly on uptrends and downtrends. In this webinar, I want to build on this theme and talk in greater detail about those price trends in instruments that you may be trading. The main takeaway in this section is that an uptrend is bullish for price action and a downtrend is bearish. Now, for traders, that's important because identifying the current trend for any particular asset is key, and because it could influence your trading decisions. An uptrend is a pattern of higher highs and higher lows in price, while a downtrend is the opposite, a pattern of lower highs and lower lows. But what information does this offer us as traders? Well, first, a trend highlights market direction. In other words, where prices are currently moving, whether it's higher or lower. An uptrend shows where traders are using any dip in price as an opportunity to buy that particular instrument again. And it also indicates where they're happy to buy at a higher price each time as any weakness is seen. And you can see that on screen right now. This buying then proves strong enough to push prices upwards, break the previous high or the previous resistance level, which then extends the pattern of higher highs and higher lows. It also means sellers require a higher price in the instrument to be tempted to sell and reduce or close their positions. And now this is an indication of bullish sentiment. A downtrend is the opposite. This highlights sentiment as bearish. We know this because sellers are using any rallies in the price of an instrument as an opportunity to sell, but at a lower level each time. This selling is then strong enough to reverse any previous rally and push the price of that instrument to a new low, below that low or that support level. A rally in price only develops when buyers become active again, but importantly, that rally starts from a lower level than was previously just seen. It's this behavior that produces the pattern of lower highs and lower lows, reflecting bearish sentiment. Now, an old saying in the market for traders is that the trend is your friend. And this can be true because if a trend remains in force, it is possible to anticipate the direction the instrument you are trading is likely to move, whether higher or lower. As traders, this is potentially invaluable because staying with the direction of the trend can help a trader to take advantage of the current market sentiment. Let's look at an uptrend in a real-world example and highlight how it could have helped to gauge directional risks over an important period, which was the recent US presidential election. On screen now is a 4-hourly chart of the NASDAQ 100 index between September the 17th and November the 14th, 2024. Over this period, sentiment was difficult to read because of the uncertainty attached to the outcome of the election and what this could mean for US equities. From September the 17th, it's possible to see a pattern of higher highs and higher lows developing. And you can use a trend line to connect those lows, which reflect the uptrend and provide possible support levels for the NASDAQ 100 on any potential sell-offs. Now, to draw a trend line on your Plus500 platform, you go to the drawing icon on the top left of the screen, click on the line tool, pick your starting point, which is the low from September the 17th, and then use that line to connect the next series of lows, and that will give you your trend line. If we move forward to November the 5th, the day of the US election, we can see that prices of the NASDAQ 100 were back to this support line marked by the uptrend dating back to September the 17th. As a trader, it's possible to decide that while this uptrend is holding, positive sentiment is still evident and directional risk could remain for moves to higher levels. Once the result was known and Trump was confirmed as the clear winner, we can see from the chart buying was strong enough to break previous resistance, which was offered by the previous high, and extend the bullish trend to higher levels. So in this example, the uptrend pattern allowed us to gauge market sentiment before, during, and after an important event. The bullish trend also helped to assess where directional risk continued to be as long as that trend line held. Now, with that in mind, of course, if the trend line was broken, that means the previous lows gave way, there would have been an increased potential for price weakness to dominate and the NASDAQ 100 to sell off to lower levels. However, importantly, as traders using this technique, we would have been aware of that sentiment change in real time and could have adjusted our trading strategy if required. Now, before we look into trending indicators, here is a slide of those key takeaways I was talking about at the start from this section covering uptrends and downtrends, and they cover the key points that you should all be aware of. If you would like to, you could feel free to take a screenshot. Okay, so far I've spoken about uptrends and downtrends in terms of just price and those price charts that you've just seen. But technical analysis allows us to confirm price activity by using various technical indicators, some of which are based on trends. These can help to back up the trends in price, giving us confirmation of the trending conditions for a particular instrument and where directional risks possibly lay. They should always be used alongside price activity as we look for them to confirm the trend in price and offer extra confidence to establish positions in the direction of the trend. Okay, let's move on and consider these in more detail. So now I'm going to talk about those trending indicators. In this section, I will cover moving averages and then move on to outline an indicator known as the MACD. Trending indicators are important because they allow us to assess and confirm what we as traders are seeing on the price action on the charts or on our screens. This increases our potential confidence in the current trending direction of an instrument. So first, I want to talk to you about moving averages, in particular, simple moving averages. These are used to confirm the current trend of a market. They smooth out price action and can be calculated over various time periods. A simple moving average is calculated by adding up the previous closing levels and dividing by the number of closes used. So, for example, a 5-day moving average adds up the daily closing levels over the last 5 periods of an instrument and then divides that total by 5. This is recalculated the next day using the latest 5 closing levels and again divided by 5. The resulting line is plotted on the price chart, and you can see this for you on screen right now. As prices move higher, the moving average will also move higher, but it will move higher below the price. As prices decline, the moving average will also decline, but this time above price. This effectively shows us the 5-day trend for the price of an instrument. Now, one point to note here is the longer the time frame, the slower a moving average reacts to price activity. So that's important for you to think about. So for instance, a 5-period moving average will follow price action more quickly than, for example, a 50-period moving average. And again, you can see that on screen right now. You can have as many moving averages on a chart as you wish, but be aware the more you have on screen, the more potentially confusing reading that chart can become. Now, with that in mind, in this webinar, we will be looking at examples using just two simple moving averages. The relationship between the two averages throws up some interesting and important signals for you to consider. As you gain more confidence in using averages and the signals they offer, you may want to increase the number of them that you use. However, for me personally, I find using two moving averages on a chart more than sufficient. So, as I've already said, if a 5-day simple moving average is rising, it reflects the 5-day trend is higher. So if we expand on that, we could say if we're using two moving averages, for example, the 5 and 10 day, if both are rising or falling at the same time, it offers a stronger picture for the trending condition of the instrument that we're looking to trade. Using this combination of 5 and 10-day moving averages, let's look at a daily chart of gold between July the 1st and November the 14th. As you gain more experience of moving averages, you may want to lengthen or even shorten these time frames. However, that depends on your own trading strategy and the time frame of your trades. But for me, I like to use a 5 and 10-day average as I feel they offer a good insight for both long and short-term perspectives. To apply a moving average or a simple moving average to a Plus500 chart, first go to the FX indicators button on the top right of the screen, type in or scroll down to moving average, put in the period you are looking for and click done. As you can see, the moving average appears on the chart. I would suggest using different colors if you are going to use more than one moving average so you can clearly identify between the different time frames. In this example, with what we already know about moving averages, we can say if both the 5 and 10-day measures are rising, gold is trading within a stronger uptrend. If they are both falling, the price of gold is in a stronger downtrend. As such, simple moving averages offer us a quick and easy way to assess the trending condition of an asset. However, it doesn't stop there. Look at the times marked on the chart where the 5-day moving average crosses above the rising 10-day average. These signals are often seen during the early stages of a new uptrend. Also, look at the cross in the averages on November the 5th. Here, the falling 5-day average crossed below the falling 10-day average. This was seen before the gold price sold off from above 2,700 to 2,545. So a point to note here as well is that averages must be moving in the same direction when they cross. If they cross but are not moving in the same direction, the direction's opposite, as highlighted on the chart that you can see on screen now, this is a neutral signal and tends to confirm more sideways or consolidation activity in price. When this is seen, it's important to wait for the confirmation of the trend, which is when prices either break higher for an uptrend or lower for a downtrend, and both averages start to move in the same direction again. When a cross is seen, where both the 5 and 10-day averages are rising, it's called a golden cross, which is bullish. When a cross is seen where both averages are falling, it's known as a dead cross, which is bearish. At this point, I should say that because of their calculation, moving averages do give lagging signals. In other words, the price of an instrument has to move first for an moving average to then follow. So you will see in both the golden and dead cross examples on the chart, they come after either price strength or weakness has already been seen. However, while lagging in nature, moving averages give confirmation of a trend. This often results in a sustained moving price in the direction of the moving average cross. Being aware of the golden and dead crosses is vital in highlighting and confirming trending conditions and can be useful when wanting to trade in the direction of a trend. Buying when a golden cross is seen or selling when a dead cross develops allows you to take a position within a confirmed trending market. Another use of a moving average is to highlight a support and resistance level within a trend. So let's take a look at the daily chart of gold, but this time concentrating on the 10-day moving average. Notice that when a correction is seen and prices sell off, but are still within the uptrend, it's the rising 10-day average that often marks a level where buyers are found again. It is from here that the upside resumes to continue the bullish trend and prices break the previous peak or resistance to extend that move higher. Within a downtrend, the opposite is true. A rally within a downtrend often finds resistance at the declining 10-day moving average, from which price weakness is resumed to extend the ongoing downtrend to new lows. So we can use this in several ways to help us when we're trading. For instance, if we're bullish of an asset within what is a confirmed uptrend, but not yet long, we can use corrections back to the rising 10-day average to buy at a lower level, as we know this is likely to be support. Or if we're bearish but aren't yet short within the confirmed downtrend, a rally back higher to a declining 10-day moving average offers a selling opportunity at a higher level because we know this is likely to be resistance. Also, we can place stops on long positions just under the 10-day moving average, or for short positions just above the 10-day moving average. The reason for this is that breaks of a moving average can see a more extended move in the direction of that break. This protects our position, preserves our capital, and any profits that we may have. Now, a big advantage of this method of stop loss placement is the stop moves or trails behind a rising average in an uptrend or behind a declining average within a downtrend. This means that when you're long in an uptrend, our stop follows prices higher, or when short in a downtrend, our stop follows prices lower, both of which means even if the stop is hit, our potential profit on a position increases as the trend extends. So that's simple moving averages. On screen now is the key takeaway slide that runs through how moving averages can help us with our trading. Again, feel free to take a screenshot, and if you do have any questions, please put them on the chat or the Q&A section so we can answer them at the end of the presentation. Okay, let's move on to the MACD indicator. So now I want to expand on trends and trending indicators even further. I want to look at another trending indicator called the Moving Average Convergence Divergence Indicator. Quite a mouthful, so we call it MACD indicator for short. The MACD also uses moving averages and offers a strong assessment of the trending condition of an instrument. We've already discussed using two moving averages to help us gauge the trend of a market, and the MACD builds on this further. It also uses two moving averages, but this time it's the 12 and 26-day averages, which helpfully are the default settings within the Plus500 platform. However, before we discuss using the simple calculation for averages, here exponential averages are used. Exponential averages change the calculation and place greater emphasis on the latest closing data for the instrument. So this goes some way to try and overcome the issue of averages being lagging in nature. By giving the latest closing levels greater importance within the exponential calculation, these averages can turn more quickly than a simple average to reflect these price changes earlier. Exponential averages, because of this, are often used in technical indicators to help speed up signals and improve performance. So what is the MACD and how does it use moving averages? Well, when we discussed using two moving averages earlier, we highlighted how a 5-day average follows price action more closely than a 10-day average. The MACD uses 12 and 26-day exponential averages and measures the gap between the two. The 12-day average will follow price action more closely than the 26-day average, meaning as prices rise above the averages, the gap between the shorter and longer term average increases in a positive way. While in a downtrend, as price falls below the declining two averages, the gap increases in a negative way. Let's further look at a daily chart of dollar-yen and add the MACD indicator. To add this indicator to a Plus500 chart, click on the FX Indicators button, type or scroll down to MACD, and as you can see, it appears below the price chart, which in this case is dollar-yen. The grey line of the indicator shows the gap between the two exponential moving averages, while the red line is a 9-day moving average of the indicator line. So what does the MACD show and how can we use this within our day-to-day trading? It's a trending indicator, so we use it to confirm the trending condition of an asset and help us to decide if we need to be bullish or bearish. There are 4 signals we use within the MACD indicator. These highlight an aggressive uptrend, an aggressive downtrend, a correction within an uptrend, and a correction within a downtrend. Let's look at the first signal, which is an aggressive uptrend. This is where the rising indicator line is above zero, above the grey horizontal line on the MACD chart, and its own average. This means the 12-day average is moving above the 26-day average, and the gap between the two averages is increasing as price moves higher. This setup reflects when you should be bullish of an asset because the current uptrend can potentially continue. The aggressive downtrend setup is when the indicator line is falling below both zero and its average. This reflects the declining 12-day average falling below the 26-day average, with both falling below price. This shows when you should be bearish of the asset because the current downtrend can extend further. But what about those consolidation signals? A consolidation within an uptrend can develop when the MACD line, while still above zero, has crossed below its own moving average. This is not a negative signal because the MACD line is still above zero, reflecting an uptrend, but suggests a reaction to recent strength, essentially where sellers have started to appear. And consolidation is possible within that uptrend. At this point in time, we may wish to close any longs and revert to the sidelines as a correction is potentially due. We would then look for the MACD to either break below zero, which would suggest a downtrend is starting to be evident, or the more aggressive uptrend starts to resume as the MACD line breaks back above its own average. And consolidation within a downtrend can be seen when the MACD line is still below zero, but has crossed above its own moving average. Here, we may want to again close short positions because of the risk of a recovery is starting to develop. This is not a bullish signal because the MACD line is still below zero to maintain a downtrend, but suggests a reaction to recent weakness. Again, in this instance, as buyers start to appear, and suggests that a recovery is possible within the ongoing downtrend. We would then look for the MACD to either break above zero to suggest an uptrend is evident, or for it to resume downside and break under its own average to highlight the more aggressive downtrend is starting to continue again. We can use these signals to either initiate outright trades or to easily help us gauge the trending setup within the instrument at that time. For example, other techniques could be used to time trades within the direction of the confirmed trend. So in conclusion, we have looked at various technical analysis techniques and indicators to help us gauge the trending condition of an instrument at any given time, supported by current examples from the markets in November. Moving forward, each technique can either be used on their own or in combination with the other. Now, I hope that helped. I can see there are lots of questions, so let's move straight on to answering some. And remember, I know we pack a lot into these webinars. They are recorded, so you can watch them again at your own leisure. A recording link will be provided to you after the webinar ends. Okay, let's move on to those questions.